Have you ever looked at your credit card statement and wondered, wait, why did my interest rate just go up? Or maybe you noticed your savings account is suddenly paying you a little bit more. Well, a lot of the time, it all comes down to one single decision made by the U.S. Central Bank. The Federal Reserve. Today, we're going to connect the dots, all the way from their big building in Washington, D.C., straight to your wallet.
So the Fed makes a move. The news is buzzing about it. But why should you actually care? Well, because whether you're saving up for something big, thinking about buying a car, or even just swiping your credit card at the grocery store, the Fed's choices create these huge waves that eventually reach you. Let's trace those waves together.
All right, first up, Section 1, the Fed's big move. We're going to take a quick look at America's central bank and the one major decision that literally echoes through the entire economy.
And what's so fascinating is that this massive economic influence, something that affects millions of people, really just comes down to the Fed tweaking one single number. It's kind of like a giant lever that can either speed up or slow down the whole U.S. economy.
So how exactly does changing one number spread so far and wide? Think of it like tossing a stone into a calm pond. That's what we're talking about here, the economic ripple effect. The waves start small, but believe me, they eventually touch every single part of our financial lives. And here's that stone we were just talking about, the federal funds rate. It sounds a little technical, right? All it is the interest rate banks charge each other for these super short-term overnight loans. It might seem obscure, but because it's the absolute foundation for all other borrowing costs, it kicks off a massive chain reaction. And that chain reaction, it unfolds in 4 pretty clear steps. First, the Fed makes its decision. That immediately forces banks to adjust their own rates. And then, bam, suddenly the cost of a car loan or a mortgage changes for you and me. And what do we do in response? We all start making different choices about whether to spend our money or to save it. It's a direct line from a decision made in D.C. right into your personal budget.
Now for the part you've probably been waiting for. Section 3, how it hits your wallet. Let's zoom right in on what this all really means for your bank account.
It really just boils down to this. When the Fed hikes rates, borrowing money gets more expensive. Your credit card debt costs more, but on the bright side, you might earn more interest on your savings. So it encourages you to save. Now, on the flip side, when the Fed cuts rates, borrowing gets cheaper, which encourages all of us to go out and spend. It's a classic economic seesaw.
And to make this super real, just look at this number. The average interest rate on a lot of credit cards is already over 20%. When the Fed raises its rate, that number starts to climb even higher, which makes any debt you're carrying that much more expensive.
And it's not just about credit cards. We're talking about the interest on your mortgage, your car loan, and even the returns you get from your savings accounts. I mean, look at this list. Almost every single corner of your financial life is touched by this one decision. Okay, let's zoom back out for a minute for Section 4, Wall Street versus Main Street, because this decision doesn't just affect us as individuals, right? It has a huge impact on both the biggest corporations and the smallest local businesses. So, on Wall Street, a rate change can make the stock market go a little haywire as big investors move their money around. But back here on Main Street, the impact feels a lot more real. It can be the deciding factor in whether a local business feels confident enough to hire new people or has to start cutting back. It's directly connected to jobs and the health of our towns and cities.
So, with all this volatility, what's the best approach? Well, here's the key takeaway. Long-term investors tend to do better when they stay strategic instead of getting emotional. It's really all about understanding the big picture, the cycle, not just reacting to every single headline you see. And that brings us to our final section, reading the economic signals. The important thing here is to see the Fed's decision as more than just a news story. You've got to see it as a signal, a clue about what might be coming next.
Because ultimately, that's what the Fed's action is. It's a powerful indicator. It's like a forecast from the country's top economist about the health of the economy. They're telling us if they see storm clouds on the horizon and need to cool things down, or if they see clear skies ahead that call for a little boost.
So the signal has been sent. And now that you understand this ripple effect, you're not just reacting to the financial news anymore, you're actually anticipating it. You can see the waves before they even reach the shore. So the real question isn't just what's next, but how are you going to get ready for it?